Gold has been seen as a top safe haven asset for decades and is still the case now. As inflation remains sticky, gold prices have spiked more than 15% this year. However, some speculate that gold is overvalued now and may not be the best hedge against inflation in the coming years. Hi, I'm Jean, a researcher at Dxpert. Let's start with why there is this gold frenzy going on. Experts attribute this year's gold price surge to increased demand from central banks in emerging markets like China, India, and Turkey, which are diversifying their reserves and hedging against dollar fluctuations. Retail investors are also contributing, with the World Gold Council reporting inflows into North American gold ETFs in March and April, reversing a trend of net outflows due to interest in Bitcoin ETFs. Additionally, Costco's popular sale of 1-ounce gold bars, fear of missing out FOMO mentality, geopolitics tensions, and expectations of a rate cut are driving gold prices to a new high. Now that we get a gist of the causes of the gold frenzy, now we'll get into our main topic. In a research report written back in 2012 titled "Is There Still a Golden Dilemma?" written by Claude Erb, a former commodity fund manager at TCW, and Campbell Harvey, a Duke University finance professor, suggested that gold was overvalued at that time and likely to underperform in the future. From its peak in 2012 to its low in 2015, gold's real price dropped by over 40%. Despite surpassing its previous all-time high and exceeding $2,400 an ounce today, the Erb-Harvey model indicates that gold remains as overvalued as it was back in 2012. This model is based on gold's price to the US Consumer Price Index. Because gold is often used as a hedge against inflation, this ratio would remain constant. But as illustrated here, the gold to CPI ratio fluctuates wildly. If the gold to CPI ratio had remained constant over the years, gold's price would have followed the red line instead of the blue line, which represents gold's actual price. Now let's put that into another perspective: the annualized returns of gold and stocks. According to the latest Bloomberg Markets Live MLIV poll survey, tech stocks like Nvidia, Amazon, and Meta are seen as key assets for guarding against inflation due to their sensitivity to changes in inflation and interest rates, as their valuations are heavily reliant on projected future profits. Over the past 5 years, gold has had an annualized real return of 8% and a 12.5% return before inflation. Now, in comparison, the S&P 500 has risen 9.1% in real terms and 13.6% before inflation during the same period. Over a 10-year period, the S&P 500 has significantly outperformed gold, with a real return of 9.5% and 12.6% before inflation, compared to gold's real return of 3.1% and 6.1% before inflation. Erb also mentioned in an email that based on an econometric model, gold is predicted to lag inflation by 7.5% annualized over the next decade. In summary, they suggest that high real gold prices may indicate that gold is overvalued, leading to unattractive returns for investors in the future. Lastly, Harvey and Erb added this statement: "So whether this surge in demand for gold will mark the beginning of a new era where real gold prices will continuously rise, or if the current spike in gold prices is temporary and will lead to a significant drop in real gold prices in the future." If you enjoyed this week's video, subscribe, like, and share. See you in the next one!